This video examines the complexities of the New York City real estate market, covering market distortions, institutional ownership, and the ongoing crisis within the city's housing safety net. The 2026 landscape is marked by a severe market hierarchy and a stressed public-private safety net. While federal policy attempts to curb corporate consolidation of single-family homes, New York City faces unique challenges, including rent freezes and structural crises in public housing. In Manhattan, corporate ownership is focused on high-density buildings rather than single-family homes. These multi-billion-dollar entities operate vertically and remain largely unaffected by federal purchasing restrictions. Major corporate players like Blackstone, related companies, and SL Green face distinct regulatory challenges, ranging from algorithm bans to pressure regarding deferred maintenance in their multifamily portfolios. In the outer boroughs, legislation like the 90-day firewall aims to limit institutional investors. In response, capital is pivoting toward ground-up, build-to-rent projects in areas like the Rockaways and Staten Island. A key concern is whether market participants might intentionally stall transactions to favor corporate cash buyers. Such tactics threaten to undermine the protective intent of current housing regulations. To combat these issues, legal protections have been strengthened. These include anti-stalling clauses in legislation and increased attorney oversight to ensure fair competition and compliance with real estate laws. For individual buyers facing potential stalls, practical actions include setting tight expiration dates on offers, demanding proof of submission, and reporting non-responsive agents to managing brokers. Sellers who feel pressured to wait for corporate buyers should review their listing agreements, consider replacing their brokers if necessary, and file complaints with state licensing boards if fiduciary duties are breached. Operational interventions are driving market dynamics. These include a ban on algorithmic rent setting to prevent artificial pricing and a historic rent freeze impacting millions of tenants across the city. While rent freezes offer immediate relief, they can have significant economic consequences for the wider housing ecosystem over time. These consequences often lead to systemic distortions, such as landlords raising prices on market rate units to compensate for income losses and the potential for deferred maintenance or apartment warehousing. The cycle continues as future boards may be forced to approve compounding rent spikes to prevent foreclosures, while property owners continue to scale back operations in response to reduced profit margins. The public housing sector is also in crisis. Programs like PACT and RAD have privatized management to address repair deficits, but this has led to increased eviction rates and severe administrative failures in Section 8 paperwork. Finally, residents of Mitchell-Lama complexes remain excluded from general rent freezes. These properties often face deep financial deficits, forcing significant rent hikes to avoid structural failure, which further strains working-class families. Moving to the issue of dual-tier enforcement, a deep conflict exists where the city aggressively fines private landlords for violations while being legally barred from penalizing its own housing authority for identical issues. This immunity prioritizes the municipal budget over the safety of public housing tenants. Furthermore, federal monitoring of public housing remains under-equipped, relying heavily on self-reported data. This approach is often criticized as a containment strategy that manages public outrage, while the physical condition of these buildings continues to deteriorate. In response, tenant unions are launching a counteroffensive. Proposed legislative battles include the End Warehousing Act, which mandates fines for long-term vacancies, and the Same Standard mandate, which seeks to strip the housing authority of its regulatory immunity. Critics also contend that the Public Housing Preservation Trust functions as a, quote, Trojan horse for privatization. Activists argue that its debt-driven financial model weakens long-term protections and allows governments to avoid their responsibility to directly fund critical capital repairs. To address these systemic challenges, policy experts suggest structural shifts. These include tax abatements for rehabilitation, expanding voucher programs to ensure stable revenue, and creating state-subsidized risk pools to manage insurance costs and protect housing affordability.